Hey, how's it going, everybody, and welcome back to the channel. If you're new, remember to leave a like, subscribe, and hit the notification bell for more. So now we're going to be talking all about mistakes that you could possibly make when you're investing in Vanguard ETFs. You have to understand the ETF strategy for one. Vanguard offers a variety of ETFs, each with different investment strategies, like index funds, etc. Not understanding the strategy behind the ETF can lead to mismatched investments with your overall financial goals. Let me get into that a little bit, right? So when you're taking a look at, let's just say, VGT, then if you don't understand what exactly the ETF, what that is, and where they're invested their money, okay, and collectively, then you're not going to understand, well, let's just say the entire tech industry, like as of right now, is down like crazy. And you just put your money in like you don't know what's going on. And let's just say Nvidia, and let's just say, I don't know, Intuit, all these companies, like collectively, are going to face a significant downturn over the past year. They're projecting really bad numbers, let's just say. Okay. Then you're investing in a bad time. Or if you're, let's just say, investing in, let's just say, January, where right before the earnings come out for a lot of these companies collectively, like VGT is invested in all of these companies collectively, all right? Collectively, they're invested, obviously, like in Nvidia, in Apple. And if they're just coming out with earnings, and a lot of analysts and a lot of people are saying these earnings are going to be crap, and they turn out to be crap, and you think, you do your research and you see all these companies which say are overvalued. I'm not just talking about analysts. Obviously, analysts sometimes don't know shit. But if you yourself actually do the research and you see a lot of the intrinsic value is like the intrinsic value of these companies, which say Apple is like night and day of what the companies should be traded at, then you might lose money if you're going to invest in VGT. Chasing past performance. One common mistake is investing in ETF simply because it has performed well in the past. Past performance doesn't guarantee future results. We get that. All right. Lack of diversification. That's huge. Another big key is, again, lack of diversification. So if you just invest all your money into VGT, by the way, I have nothing, I need to say, I have nothing against VGT. The past performance, okay, past performance doesn't refute, we get it. But in all seriousness, though, I was just doing a play on what I just said. Past performance doesn't equate to future results, etc. But we get that, all right. But at the same time, too, okay, VGT is still up 1,073.33% all the time. Okay. That you have to talk about that when we talk about VGT, because there are also companies that perform like ETFs. I mean, that perform like crap. That you have to take a look at too, and you need to have that in the conversation as well. The lack of diversification, but if you just invest in VGT you're just investing in technology. So if you're not invested, let's just say, in waste management, you're not just invested in, I don't know, Home Depot or something, then you're and if the tech industry goes to absolute crap, then you might be screwing yourself and you just don't even know it. Ignoring the expense ratio, which is pretty big. So Vanguard is known for offering low expense or low cost ETFs, but investors may not pay enough attention to their expense ratios of their ETFs as well. Not rebalancing your portfolio over time, the performance of different ETFs can cause your portfolio to drift from its original allocation. And we also, I think I talked about in the last video too that I just did, market timing. Attempting to time the market by buying and selling ETFs based on short-term market movements is a common mistake if you're doing this for retirement. Trying to predict market tops and bottoms is nearly impossible and often leads to poor decision making. But at the same time too, you have to take a look at earnings reports, and you have to take a look at the trajectory of these companies. If there's any warning signs with some of these companies, like if there's something going on, okay, like with technology companies, if they're up like absolutely crazy and everybody loves these companies and they're performing so well and everything is like nonstop going to the moon, that's the time you should probably take a step back and say, well, let's take a look at the intrinsic value of some of these companies. And the intrinsic value is probably trading way higher than what the companies are actually worth, what the intrinsic value probably should be. Peter Lynch's formula is, try to buy companies below its intrinsic value. It takes maybe an hour, maybe 2 hours, 3 hours to just, analyze some of these companies and see, maybe right now is not the best time to trade Microsoft when it's let's just say, trading at $445 when the intrinsic value is, I don't know, whatever it is, like let's just say $230. Like this isn't rocket science. And by the way, Microsoft is now trading well below $445. And I knew that. I knew that it was going to be. All right, I was like, all right, Microsoft, of how it's been trading, it's just all. I mean, you could take a look at yourself from the past year, So that's. I mean, I just provided a lot of great information. If you're a beginner to the stock market, right there. And so remember to leave a like and also subscribe. Thanks for watching, everybody.